Good evening from London. Today we are talking about the falling mortgage rates and buy to let, whether there is a big comeback given that rates are going down, despite the Bank of England keeping on hold. And this is despite the Federal Reserve in the US cutting by 0.5%. Now, further along this video, I'll share with you why that's important and why the US cuts are so important in the economy overall. We have a very special guest today, which will be joining us in the next 10-15 minutes. So make sure you do stay on. We will be talking about the Federal Reserve. We'll be talking about how the US economy impacts other countries. We are very much living in a global economy, and especially when you have a superpower like the US, we tend to follow whatever they do, or there is a knock-on effect at least. As many of you already know, it's been probably around about a week. The Bank of England has held the rate as is at the moment, and I just want to dive straight into some articles because despite the Bank of England keeping it that way, we are already seeing cuts from lenders. But let's go into this article from AP. So, London AP, the Bank of England kept its main interest rate unchanged 5% Thursday, despite big cuts from the US Federal Reserve. And it's first since the onset of the coronavirus pandemic more than 4 years ago. 4 years. I mean, it doesn't even feel like 4 years, but a lot has happened, of course, since the coronavirus. Property has gone up, has gone down. We've had a chunk of regulation thrown at, especially buy to let investors. But we've seen kind of a build up to that, even with the Conservative Party since 2016. And we're also going to discuss and break down as to how the mortgage rates have impacted buy to let investors, but also Section 24, which seems to be the biggest impact. Because one thing we do know is that although the mortgage interest rates go up and down, and I'm not saying in any way it's been a walk in the park for a lot of buy to let landlords, investors out there. But even though mortgage rates go up and down, that is, I say it like a business. You know, some businesses have good years, some bad years. Sometimes you break even. However, what has been detrimental to the buy-to-let industry has been the Section 24, and then, of course, the combination of those mortgage rates increasing substantially over the course of recent years. So let's jump back into the article, which again goes into that the decision was expected amid ongoing concerns about inflation with the bank's monetary policy committee, particularly the elevated levels of crucial services sector, which accounts for 80% of the British economy. And if I know anything, is I know a chunk of that is based here in London when it comes to those services. So figures on Wednesday show that inflation overall in the UK held steady at an annual rate of 2.2% in August, still above the bank's goal. Minutes to the meeting show that 8 of the 9 members of the panel voted to keep rates unchanged, while one backed a quarter point reduction. The economy has been evolving broadly as we expected. If that continues, we should be able to reduce rates gradually over time, said the bank or the bank governor. So, question is, where are mortgage rates going? And what we do know is that lenders are getting ahead of the Bank of England. They are expecting the Bank of England to do a reduction at some point before the end of the year. Now, the big question is that reduction going to be as big as the US, where they've gone 0.5% at the moment? Their mortgage rate, they do it by range. So their mortgage rate is between 4.75% and 5%. So the question is, are we going to see that 0.5%? Because the Federal Reserve has indicated that they are wanting to cut another 0.5% before the end of the year. And things that they're looking at very specifically is unemployment. So if unemployment goes down, they will not hesitate to cut rates, and also in combination with inflation. If they see that inflation starts to go up, they also won't hesitate to cut those rates. So again, we want to look at this from a global point of view, which is why my very good friend is going to be joining us very shortly. So hang in there. In the next few minutes, he will be joining. Now, I usually start this stream with asking whether if anyone can hear me, and I've just rambled on. So, hi, Danny. Good. Do you think your lower mortgage rates? Yeah, absolutely. Donna or Samantha or anyone out there listening, if you could please give me a thumbs up, let me know whether my audio is all good. Yes, we can hear you. Amazing. That's good to hear. And apologies, talking about the inflation. So it's the other way round, I believe. Inflation goes down, and the Federal Reserve won't hesitate to cut those rates accordingly. So we have a few articles to review today, and mainly I wanted to see that mortgage rates have started to go down already, despite Bank of England keeping the rates as they are. So buy to let mortgage rates fall despite interest rates hold. So the decision comes a day after the UK inflation stuck at 2.2%, August above the bank of 2% target, while a rise of both core inflation and service inflation. Last month, its Monetary Policy Committee voted to cut rates from 5.25%, the first reduction since the onset of the pandemic. So again, a little bit of repetition there. But since the previous cuts, many big lenders have announced reductions to the buy-to-let products due to more favorable market conditions. The reality is it's very competitive out there for lenders. Now, this is a good thing for landlords and investors out there, because this means they're going to do everything possible to obviously outbid their competitors. Now, one way that a lot of these lenders have been able to make numbers work, and especially for landlords, is of course what we've seen over the course of the last few years, which is the fees. Now, this is something that wasn't normal sort of pre-pandemic, but it's become kind of the norm now, where there are sort of those big fees up front, and that way you can also get that lower mortgage rates. I'm sure if you have reviewed your mortgage recently, you would have seen those big fees, which perhaps you hadn't known about in previous years. So, Accord Mortgages and Virgin Money have both just dropped rates from buy-to-let mortgages. Virgin's buy-to-let 5-year fixed rate with a 3% fee, as I've just said, now start from 3.8%, and rates with a £2,000 fee have reduced by up to 0.10%, now starting from 4%. So that's interesting looking at these fees. If we look at, for example, I mean, I'm just thinking a lot of landlords that I connect with on a weekly basis. I would say probably here in London, you're looking around about £750,000, and then if you add that 3% fee, you're looking at a lot of money. You're looking at 20 grand. If you're looking at a mortgage of £500,000, that is a lot of money. And of course, this adds to landlords pricing here, especially buying property in London, which we've seen that fall substantially in comparison to the north. And this is again based on mortgage rates, house prices, and we can see that division when it comes to both the activity of buying properties between the south and the north. We're seeing substantial activity when it comes to purchases, and south is lagging somewhat. Will we continue to see this in autumn? I'm seeing activity all around the UK, but again, the southeast does lag when we compare it to the north. There are two markets happening there at the moment. Any questions, guys? Just feel free to send across. How do you see this affecting rental yields, high demand areas? Let me bring this up. This question is from Jonathan. So, well, it will affect it in a good way, Jonathan, in the sense that, of course, if we have cheaper lending, that naturally will mean that a land will have more money in their pocket. So it's really keeping an eye. If you're not working with a broker at the moment, you should really do so, so you can look at all your options. But hopefully, in a positive way, it will affect and impact landlords. So I don't see any other questions at this point in time, so we're just going to wait for a few minutes. Any question with regards to the market, rental demand, anything like that, just feel free to ask. We do look at the broader picture, not just mortgages, guys. So feel free to just ask the question. Okay, guys. Here's another one from Donna. Good info. Do you think if the lower mortgage rates be enough to counterbalance the impact of renters reform bill for landlords? That's a good question. Listen, one thing I'm going to say, Donna, is that regulations and legislation is going to change all the time. If you're going to buy property based on renters reform and regulations and so forth, and you're not going to buy a property, then property is not going to be the right investment for you, because if you're holding property over the course of, I don't know, 20 years, chances are that throughout that period of time, uh, governments are going to change and policies are going to change. So if you're going to get worried or nervous every time a government comes into play and wants to change regulations ever so slightly, then it may not be the best investment for you. Sorry to be blunt, but that is the answer that I have. Now, one thing to point out is one of the things that most landlords were scared of that I have spoken to. There were a couple. Now, one of them was the abolishment of Section 21, which I had somewhere. There was a survey done by Paragon Bank, and it was very much talking about what was the biggest concerns with the Renters' Rights Bill, or at that time, the Renters' Reform Bill. Of course, we have Labour who's come in, rebranded and repackaged. And the biggest concern that landlords had was, without question, the abolishment of Section 21. Now, I don't know if that was specifically because they were getting rid of it, or whether it was a concern around of, if it was abolished, which it will be, have no doubt about that. What other mechanisms are going to be in place to have a valid reason to evict your tenant? Because that's really what's happening now. That no fault eviction, Section 21, will go out the window, and now the way that you are going to be able to evict the tenant is going to be very much based on having a valid reason, such as, you want to move into your home, you want to sell your home, you have a family member that needs a home, and you're going to provide that for them. Now, that is still going to be in place. Now, the rules of the game do change. What way? Well, from what the proposal of the Labour has put in, is that the first 12 months you won't be able to do that, and then the notice period to get that tenant out to be able to sell the property is also being extended. So you still have rights as a landlord to be able to do what you need to do with your property. It's just the boundaries around them have changed. So I hope that makes sense. Now, that's number one. That was the biggest reason. Now, the second biggest concern that landlords had with the Renters Reform Bill, previously Renters Right Bill. I need to keep up to date. They keep changing the name. Is the abolishment of a fixed tenancy, so the indefinite tenancy, and what that means. Now, if you want to find out more about this, there is a video coming out in the next couple of days. So if you're not subscribed, make sure you do, because I'll go in depth with regards to the Renters' Rights Bill. And so if that's something that you want to dive into, that you have concerns about, subscribe and make sure to look out for that video, which will be out on Saturday. But for the purpose of this video, what I'm saying is, would it counterbalance it? Not necessarily. And I don't think you want to be looking at it from a counterbalance point of view. Just make sure that you make the adjustments that you need to make as a landlord to be able to navigate through these new regulations. So, talking about the buy to let, so we were discussing the rates. So we can see 3% fees. Starting at 3.8%, you can secure those mortgage rates. But again, you have a whopping 3% fee to pay. And we just looked at, if you're looking at a £500,000 property, or £500,000 mortgage, you're looking at £15,000. That is big money. But these fees have become just, very common in today's market. So Nathan Emerson, CEO of Property Mark, says that since the initial rate cut a few months ago, many people will have been closely awaiting any further anticipated cuts. However, it's crucial the Bank of England continues to do this in a controlled and functional way to not risk reversing economic progress. Now, there's been a lot of people criticizing the Bank of England, saying that the Bank of England simply didn't cut rates fast enough in the last 24 months as the inflation got out of control. Because if we compare this to the US, and we have again a very special guest jumping on, so be patient. He's jumping on, from what I understand, in the next 10 minutes, and we can compare the US to the UK. And the context of that is, of course, that we do tend to follow what this superpower US does. So looking at the critics, at least from the Bank of England, saying that very much the Bank of England should have cut rates quicker, as did in the US, which the inflation really didn't peak to the extent that the UK did. I mean, we had a huge inflation, which is, if I'm not mistaken, was double digits. But we got that on the wraps now, and the UK property market has proven to be, quite frank, quite resilient. So I think we're done with this. And if we have any other questions, let's jump on to this. So what do we have here? How do you see this affecting the rental yields? We talked about that already. Let's have our look at our guest. Yep, so Kevin will be jumping on very shortly. And let's go into... I feel like there will be some potential risks if we will be facing as buy-to-let investors, even with a lower rates. Yeah, I mean, property comes with risks, Samantha. So absolutely. But again, you need to... most landlords that I've spoken to, they are quite relieved that we now have this renters reform bill going through. This now gives more clarity to investors and to be able to make informed decisions rather than to go on speculation. So now we have a solid announcements. This has gone through and will be up for revision. I believe it will be scheduled on the 9th of October. So if you haven't subscribed, do so you can be updated with that. So yeah, absolutely, there are risks. There are always going to be risks. But I'll tell you what, Samantha, if you can make the numbers work in today's market, you're going to be able to make it work in future markets, because no one has a crystal ball. But as far as we know, we've been thrown so many things over the course of the last few years, and the London and the overall UK market has been very resilient. If we look back, we have the Osborne era throwing landlords everything at it, whether it's the stamp duty surcharge for second homes, whether it's the removal of the wear and tear, Section 24. Then after that came Brexit. After that, we have a COVID, and then we have recession. This is pretty much, I believe, as bad as it's going to get. And the UK has been resilient, and there are landlords out there that are making those numbers work. So I hope that makes sense. So we have another question here, but Danny, how can first-time landlords take advantage of falling mortgage rates? Well, believe it or not, I mean, this is me assuming, Martin, that you are in your 30s, because you're talking about first-time landlords. One thing we've seen, there's a survey done, and if anything, we know that there are more younger landlords applying for buy-to-let mortgages. So, sort of, I think it's sort of mid 30s to late 30s. That's changed very much so in terms of the demographic and the psychographic that we've seen before. And I think that younger landlords have an advantage whereby they can sort of drive see this through. They have time on their hands. Other landlords that don't have the luxury of years um, ahead of them may not be able to drive this through and wait this out. I hope that makes sense. Wise process. It would be great to have your take on rent caps. They could they negatively impact landlords' profitability in the long term? Great question, because I was just about to dive into tying it into landlords' concerns. Some of the biggest landlords' concerns, as I said, it was that Section 21. It was that the removing fixed tenancy and going into an indefinite tenancy. But to wrap that round as well, one of the biggest concerns was rent controls. And we got to be clear on that renters' right bill. There isn't anything there with regards to rent control. Okay. It's very different, the proposals that they put in place at the moment, which is very much that landlords can set the rental price at market rate, which is completely fine. There is nothing different that's happening right now. I mean, I don't know any landlord, to be quite honest, that decides to put rental rates above market rate. It just wouldn't make any sense, and renters will, of course, just go to another property that's available. So that's something that we need to be very careful of. It's not rent controls what we're looking at. There is an end of rental bidding wars. And how they're going to control that, that's something that we're going to dive in a little bit more deeper. But anyway, guys, as I said, today's live stream is very much talking about mortgage rates. The Bank of England decisions and what we do here in the UK is very closely connected as to what happens in the US. And we saw the the Federal Reserve cutting that by 0.5%. A lot of us thought that the Bank of England was going to follow. However, it didn't happen. You could call us somewhat optimist. And we do have Kevin today, a very special guest, who is going to be sharing his insight into the US. How you doing, Kevin?
Oh, there we go. I'm doing great, Danny. I'm sorry I'm running a little bit late here today.
That's absolutely fine. You know what? Your timing has been absolutely perfect. We've dived into a little bit about sort of investors, what's been happening, a little bit about regulations, but also the impact of the Bank of England sort of staying on hold. So I'm not sure how much you know about what's happened. So, just a few days after the Federal Reserve adjusted their rates there in the US, the Bank of England decided to hold here. And so we were just talking a little bit about inflation and so forth. So it'll be interesting to find out a little bit of background, if you know, with regards to the Federal Reserve, the reasoning behind slashing that by 0.5%. I don't know the history as to when was the last time they had slashed it, how long they've been holding it, anything like that. And also, if you know anything about what's that about a range. You guys have a range between 4.75% to 5%, right?
Right.
Um, I don't know the reason behind that, but if you can elaborate on anything like that, that would be great.
Well, I will tell you my crystal ball for all this is in the shop right now. So I don't have that today to predict everything, but what I would say is the cut that came on September 18th. I mean, it was expected. I mean, so for interest rates here, for mortgage rates, I should say, it hasn't really affected anything right now because those rate cuts were already kind of expected and kind of baked in. So it's interesting, on this side of the pond here. We had a lot of people who are out in the market, both investors as well as people looking to purchase primary homes, who are waiting for September 18th or September 19th to roll around. And they haven't seen that come on the back end with a real cut in mortgage rates just yet. this was the first Fed cut since 2020. So, right there, that's positive, I think, overall. I do think that most of us are looking at, our mortgage rates, trending downward. I don't think that anybody's really predicting that they're going to be in the 3s or the 4% anytime soon. But right now right now we're kind of hovering in the low 6s right now for mortgage interest rates, and so it's going to be interesting. I mean, I'm kind of excited. It's the rates coming down some have brought both, especially a lot of home investors into the property or into the marketplace in our area recently.
Okay, so that's helped sort of boost confidence in your area for buying properties, for investment in particular.
Yeah. So, once again, since I do work with both, both investors as well as, people looking to purchase for their primary residences, um, I'm seeing a lot of investors right now for basically two reasons. Number one, and I can only speak to our market here. I'm out of in the DC area. So we're close to all the stuff that's going on here. So in the Washington DC area, I mean, typically our you know the strong quarters for sales are usually first and second quarter. Third quarter seems to slump some, and then fourth quarter, we always see softening, with the exception of 2020 and 2021, where everything was just balls to the walls busy for almost 2 years straight. We see seasonality in the marketplace, and we see, typically, like I say, the first 6 months of the year are very strong with sales. The last 6 months, it starts to slow a little bit, and that's typically when investors enter the marketplace. So this is kind of, in my opinion, a little bit of a small window here, where they typically come out between September and December to find properties out there, when everybody else is kind of like, sitting back and, waiting for spring of 2025. They start entering the marketplace, but the interest rates having dropped have definitely encouraged that even more.
Understood. Okay. And then is rental sort of seasonal out there? Because I know for here, I mean, we're having I'm sure we're going to have a very strong autumn. We finished with a very strong summer. There's a lot of activity here in the UK. And I believe that may be somewhat connected to, as you just shared, an anticipation of those cuts. The Bank of England, even though they held this time around, they did cut by 0.25% a few weeks back. So that gives some type of optimism, and we know that there's going to be a further cut. I don't think they're going to be as generous as the US, where you guys are sort of cutting by 0.5%. But there is sort of that notion that they will continue to go down. And the lenders, very much as you shared, lenders were kind of ahead of that because they already knew. And in fact,
Right.
even though the Bank of England here held, I was just sharing an article here, and let me just see if I can review this. I was sharing an article whereby mortgage rates are already come down despite the Bank of England keeping that on hold. I don't know if you can see my screen. Can you see my screen,
Mhm. I
Kevin?
can, but I'm going to
Cool.
put my glasses back on. Yep.
Go ahead. So it'll be interesting to compare this sort of to what's going on in the US. First thing is that what's become very popular, but only after sort of inflation came in and mortgage rates became crazy, what became very, very common, which wasn't, was fees. That maybe a landlord will have to pay sort of £500 or £1,000 fee and then get a good mortgage rate. Now they put it down on a percentage, and it's 3% in some of these, in order for you to actually secure a great mortgage interest rate. So as an example, I'm going to show you with this. 5,000. Okay, for example here. So bringing 5 years rate, so you could get 5-year rate over £1 million, up from 65% loan to value with a 3% fee. So if you imagine a 3% fee on a property of over £1 million, that's a lot of money.
It's huge. Yeah.
that's a lot of money. And even down here, for example, let's say here for houses of multiple occupancy. So I don't know how to explain multiple occupancy, but let's say holiday let purchases, which you're probably
Right.
more familiar with.
Right.
5-year fix is suitable for holiday lets, 75% loan to value at a 5% mortgage rate. But again, that's with a 2% fee. Now, if you
So
look at the average debt here from landlords, I mean, I don't know what the average is overall, but certainly the average from the investors that I speak to, maybe they owe probably around £500,000. With a 2%, that's a lot of money. You're looking at 10 grand. It's a lot of money. Is that popular in the US?
So I was going to ask you a question about that. So, when you're talking about the 3% fee or the 2% fee, are these mandatory fees, or this is, this just comes along with getting the mortgage?
Great question. So, with most lenders, they will give you an option
Right.
whereby, and if I show you this interest rates monetary, which one is it? It was the AP. So most lenders will give you the option whereby if you pay this 3% or 2% fee, you're going to get a rate at X. But if you
Right.
don't want to pay the fee, then you're going to get the rate at Y. So
Right.
that's it's not
And
mandatory.
we have something very similar. We call them discount points here. So, like, I might ask for one of my investors, or, for one of my clients, give me your best. We call, like, once again, we call them points, and 1 point is equal to 1% of the loan amount. So $500,000 loan, each point would be $5,000. So oftentimes, like, I might ask mortgage lender, give me your very best 0 point quote. Like, what is the best rate you have with 0 points? And then we can start then potentially. It, most of the cases, most of my clients are going with 0 point quotes, especially today. Now, back late last year when the rates were kind of up closer to 8% or so, it wasn't abnormal where, either they would pay points themselves out of pocket, or would request, potentially a help from a seller to pay for discount points or something like that. But right now, with rates kind of going down lower, I'm not seeing people paying a lot for these upfront points, just simply because I think that most people are thinking, I don't want to pay a whole bunch of, let's say $15,000 in the case of 3% on a
Sure,
$500,000 loan. I don't want to pay
sure.
$15,000 upfront when the rates are starting to come down. There's a very
Yeah.
good chance that, 6 weeks from now, I may have just completely wasted $15,000.
For sure. But there's a huge difference, and for viewers online, here to give perspective, because there's a big difference here. Now, the thing is, you can end up paying that 15 grand or 20 grand, whatever the percentage is, depending, of course, on what how much money you want to borrow. But the typical length of mortgage here is going to be 2 to 5 years. So in 5 years, you're going to have to do the process all over again and potentially pay fees if that's the route that you want to take. Now, again, for viewers online, the major difference here is that in the US, the typical length of a mortgage is what is that, Kevin?
30 years.
so so there's an upside to that, right? You may be able to secure an amazing mortgage rate, pay 10 grand or whatever that may be on a high fee, but you're not going to have to pay anything again until 30 years. Well, 30 years you're done,
Yeah,
right?
and that's one of the well, so, just to let you know, Danny, I actually did review the notes you sent me in advance, and I was going to ask
Okay.
you about the 2 to 5 year mortgage, because that's like, we that's completely foreign to me. I mean, we do have those options here where you can do like a it's a 30-year mortgage, but it's like, let's say it's might be maybe fixed for 5 years or so at a lower rate. So let's say the mortgage rates were, in today's market, rates we're looking at for a 30-year fix is right around six and a quarter. I mean, you might be able to get a 5 year or 7 year fixed rate for 5 or 7 years. It's a third, and then ultimately, and then maybe that would be at 5 and 3 quarters. Maybe it's like, 0.5% underneath the market, but it's for 5 years. And at the end of 5 years, it then reverts to a 1 year adjustable, where it's adjusting every year. Um, so for people that are thinking about, well, you know what? I may be out of here in 5 to 7 years. This isn't a 30-year house for me. I mean, it might make more sense to do something like that. But I was completely unaware of your 2 to 3 year mortgages. I mean, that changes things drastically. And part of the problem we've had here over the last few years, because everybody complains about inventory being low. There's no inventory out there. Well, for the last basically since 2022, I mean, the reason there's no inventory on the market is because you had all these people who bought in 2020, 2021 at 3% interest rates. And while they like the idea of moving, they're not going to trade. A lot of people aren't going to trade a 3% for seven and a
Of
half for
course.
8%,
Of course. You know
and
what?
so
I
it's
never
kept
thought
people
about
from,
that.
yeah, it's what we call here rate lock. I mean, there have been so many, or rate freeze. I mean, so many people have been frozen into their home because, hell, even if they didn't buy, during this, that pandemic period, if they refinanced. And so
Yeah.
I'm not 100% sure what the numbers are today, but I would venture to say I've seen reports that I want to say it's like 60 to 65% of the U.S. mortgages right now are 4% and below. And because of that, that's why it's been really tough getting inventory to the market. And prices have remained high. You know, we're starting to finally see that, I think, kind of unlock a little bit. Um,
Mm-hmm.
and I think part of it is because interest rates have come down some. But I think the bigger part right now is there's clients of mine who've been telling me for 2 or 3 years, like, Kevin, we'd really like to move. Like, we'd want to be closer into work, or I want to get my kids into this school district, or we need a bigger house, we need a smaller home. But it's like, as much as they like that idea, swapping out 3% for 7.5%, that's a big ask right there. But I think finally you're starting to see people who are like, you know what, we've waited long enough. Rates have come down some. They're not the most wonderful, but they come down some. We got to freaking move on. We can't wait
Yeah.
forever on this. So we're starting to see that free up a little bit. But
So a little
you
bit
know,
more activity out there. So
yeah, and just one more thing to say too is, and I'm just speaking for our local market in the DC area, but countrywide within the United States, I mean, inventory is definitely growing. I mean, we have today in our area 35% more inventory on the market today than was on the market the same time last year, which on the surface sounds like a lot. And it is a lot. I mean, it's significant, but still inventory is extremely low right now. I mean,
yeah,
it's like having a pond that was almost down to nothing, where the fish are all flopping around and dying, and now it's gone up a little bit.
sure.
But
And
it
is
would
that
be
a back
really
at the
interesting to.
back of is that at the back of more people being able to make the numbers work?
I'm not sure I understand that.
So is it
Repeat.
the back of mortgage rates sort of changing ever so slightly, even though they continue to be higher than what they would like it to
Right.
be, but
Right.
now being able to make the numbers work for them to be able to move? Is it at the back of that, a
Yes.
combination?
Yes.
Yeah.
And yeah, and that, and our broker. I work for Compass, which is the largest brokerage in the United States. And our CEO, he calls it the 5 Ds that get people to move. And I may not remember all the Ds offhand, but there's diamonds, meaning somebody's getting married. Their chance, life events.
Cool.
Diamonds, divorce, death, diapers, all these life events. Ultimately in the end, rates can be wherever they are. I mean, life events occur and then people need to move. It's just that, especially during the early COVID days, I mean, I had friends of mine, I had clients of mine, neighbors of mine who, you know, I had a beer with them, was grilling out, doing some hamburgers or something, a week or two earlier, and, no plans of moving. Then all of a sudden COVID hits and it's like, well, damn, I never need to go back to work again. And, I can work remote, and I'm going to
Yeah.
sell
Yeah.
and buy at the beach. And so there was a lot of these like kind of knee jerk reactions where people were
Change your
selling.
lifestyle. Yeah.
And
Well,
now it's gotten to really just the people that have to move. Death, divorce, maybe relocation, people have to move. But I think that's starting to kind of free up a little bit, and the interest rates lowering will encourage that even more.
for sure. Okay. What I'm going to do is, I mean, most of people who jump in, whether they're live right now or recorded, they are going to be investors. So what I'm going to do, I'm just going to share a little bit on the rental yields right now,
Sure.
and sort of the housing market. And it'll be good to get your perspective in terms of how this compares to the US, in terms of a yield, but also sort of rental demand and supply and so forth. Because I have the impression that that the rent sort of increasing is not just based in the UK. It seems to be something that's happening worldwide in terms of availability. So we'll dive into a little bit on that. Let me see if there's any other questions before I dive in. Uh, So we have Donna. I'm confused as if now a good time to consider investing in properties outside major cities, or is the urban rental market still stronger? That's a great question, Donna. So if I know anything is this, yes, during the pandemic, there was kind of this trend of people wanted to go out of the city. Again, Kevin just shared, why have to stay and work in a city if I can sort of be somewhere in the mountains or on the beach, work with my computer? I'm guessing that you had something very similar out in the US, right? Which you just shared.
100%. Yeah.
Absolutely. So, Donna, yes, and there is an element of that, but the reality is for property investment, you're going to have so much more demand in urban areas. If we know anything, I was reading an article the other day whereby what we know is half of the population actually live in urban areas, so in cities or surrounding the cities. So if you think about, I don't know what the population is at the moment, is it 8 or 9 billion? So we know that 4 billion people around the world actually live in these urban areas, and that's set to increase in 2050, double. So that's a huge amount of people. So if I had to kind of pick an area, it's certainly always going to be towards the urban areas where you're going to get that demand. And something that we're seeing as well, if there's anything to follow, I don't know where I read this, but if you look at sort of the great investors across the world, um, what we know is that a lot of companies kind of follow what they're doing, right? Whether it's the market shares and everything else. The same can be said with the big players and properties that enter the market. Now, in the US, I know it's already happened now. How long it's been happening, but I know it's already started for a few years. But here we're only just beginning to see the big corporates, the investment funds, the banks, insurance company actually entering into the market, becoming landlords. Um, and this is going to be. I'd like to find out your view and your experience on this, because we've only just started to see this in the last few years. But I know I love to read and keep up to date what happens in the US. But I know that started already. Um, tell us a little bit more about that. So specifically, what I'm talking about, Kevin, is corporate landlords, corporate investors coming into the market and becoming landlords and buying up homes.
That's a great question, and it's funny because I actually did a video on this very topic probably 6 months ago. And Personally, I'm not seeing so much of it around our area in the DC area, but where that tends to be happening more is a lot of, like, as we call them in the States, the Sun Belt country or Sun Belt states.
Hmm.
You've got that, like in Florida, um, Arizona, some of those states, as well as even some like the Midwest, in towns like Detroit. I know Atlanta is a big one as well. And my now, so I'm not really seeing it on daily on it. It's and what kind of prompted me to do the videos, I kept hearing about, there was actually legislation here in the United States about not allowing any more corporate investors that have over a certain amount of properties. Now, personally, that's really what my video was about. Personally, I don't think that legislation is going anywhere, and that was kind of like on the radar about 6 or 9 months ago. We've heard nothing about it. At the same time, there's been a heck of a lot of world events, and
Hmm.
so my guess is that's going nowhere. But when I kind of did the research, because it's like, gosh, I'm out in the marketplace every day, I'm not seeing this. But in really doing my research on it, it tends to be more lower income areas. driven by zip codes, where you have I don't know if you're familiar with zip codes, but
Yeah,
zip
yeah, yeah.
codes are just below, right? So, but I know that like Atlanta is a big area, parts of Florida, but they tend to be some of the areas that have been kind of hollowed out, with inflation and just with, I think, things that have gone on within the city. So I've heard a lot about it. I'm not witnessing it in my neck of the woods. I think because the prices are, probably prohibitive of that. Doesn't make sense numbers wise, but yeah, I mean, I'm hearing a lot about that and throughout other parts of the country. But it tends to be the Sun Belt area, Arizona, Florida, and even Midwest, like Detroit and some Ohio, places like that.
Yeah, I mean that's certainly something that we're seeing here, and I know a lot of landlords sort of worried about that. And it's just, you have the likes. I have something here, for example. Let me try and share
Are you
this
seeing the
while we're
same
out.
thing though, based on, locations where these tend to be happening more and more kind of, I mean, I hate calling it what it, but more of your lower income areas or so?
No, not at all. No, these are good areas, upcoming areas. And what they tend to do is we call it here build to rent, and it's the build to rent market where these companies. So you got banks like I mean, I want to show you this article. Like Lloyd's Bank is banking on a generation rent. So Lloyd Bank plans to become private landlord. They already are pretty much. And they are coming into good areas, upcoming areas, building very good buildings. So this is what I'm talking about is more so build to rent, where they build a block of flats, whether that's 20, 30, 40, 80, whatever that may be, very good amenities, sort of gyms, good access into the city, if not in the city itself, very good property management, security, sort of CCTV camera. These are accommodations that are going to demand very, very good rental income. So certainly not on the low end.
Are you talking mostly flats that they're purchasing and then just completely renovating them, or are they tearing
So
things down, rebuilding, or
yeah, so great point. So what I'm talking about is starting from scratch. So literally buildings, new buildings. They're not, but they're buying lots and actually building from there on. So starting from scratch. And that's something that we're seeing more and more. And renters, what I see is a trend whereby renters, that's what they want. Where they've come to
right?
the conclusion whereby, you know what, I don't, I don't, I don't see myself buying a property. I'm priced out. I want to stay in this area. It's a good area, and I'm that damn, I'm just going to rent for the next 10 years, and therefore I want to be in a good area. I want to have good building. I want to have good management, and all these things, and good amenities. So that's what we're seeing at the moment. The
I
rise
mean,
of
how much
corporate
how much
landlords.
how much empty land do you have around you? I mean, I would think that everything's so built up and, you must be moving further out. That's why I was asking about tearing down, and we see a lot of that going on in DC and kind of some of the
Yeah.
close in suburbs where they're tearing things down that were turn of the century, not turn of the 21st century, but probably turn of the 20th century. Um, and starting to rebuild new places. But what are you seeing there? I mean, you got to be moving
So
further out if you're looking at empty lots.
Yeah. So when you look at places like London, what you have in London is there are quite a few areas that are being regenerated. So you got regeneration going on in different places, and what you have in London specifically is almost this sort of different villages in the city, and they all have different vibes and different sort of transport connections and everything else. So yes, there are places that have been torn down and they're building back up, and there's a percentage of those places whereby you have these build to rent that we call it, and that's where they're building. So you're going to have a percentage of those whereby that's the kinds of properties that you're going to have when it
Right.
comes to London. And then across the UK, and especially up north. Here in the UK, in England at least, you've got this north and south divide. So north has typically been this place where you get kind of this low end market. But I don't believe it will ever, I say never, but it's going to be rather challenging for it to catch up where the southeast is. But it's given it its run for its money, and the percentage of rental income that it demands is getting narrower and narrower between south and
Wow.
north.
Yeah.
And so that's where a lot of these places are really focusing on. So I wanted to share with you, for example, is this one here. And I'll be shooting a video about this because it's become quite a bit of a talk. So banks as landlords impact on first-time home buyers. So the government, again, there's always a cause and an effect with these type of things, and we've seen this with regulations with landlords, by the way. And I'll talk a little bit about that because I can have a rant about that. But hold on. So with regulations, that cause and effect that we've seen, where the government comes in to try and protect tenants and renters' right, but every time they do a change on the law of a legislation, it affects and impacts the very people they're trying to protect negatively. And this is part of this as well. So what we can see is the government sort of given the green light to more and more of these corporate investors to try and free up sort of more properties to make the rental market a little bit more promising, but it's having an impact on first-time buyers. So that's what happens when you intervene and start messing about with the market. But for example, if you look at this, look at recent trends of bank purchasing properties to rent out and what it means for first-time buyers. Then there was Raymond for 50. So at the moment, the government that's come in, just to give you some context, the government that's come in right now has promised 1.5 million homes over the course of the last 5 years. Within the next 5 years, how they're going to achieve this, I think this is part of their great plan, to be able to deliver on that. But if we look at this here, we've got to own 10,000. So the Financial Times claims to have seen an internal job advertisement of Citra Living outlining long-term targets, including strategic challenge to own 10,000 properties by the end of 2025, with a further 40,000 in 2030. And all these properties, most of these properties at least, they are in major cities, or at least close to major cities, to go into to be able to have good transport. You've got Fletton Keys development, Petersborough Park, separate target. Granted, London has less of this, and that could be part of what your question is: how much land do they have to build on? And the truth is, in London, there isn't going to be much in comparison to other cities. Yet you do have these regeneration areas where they have torn down a fair amount. I mean, I'm talking about areas you're not familiar here, but I am talking about areas sort of like Brent Town, where they literally just constructed and built a new town in that area, and a lot of buildings going on there. King's Cross, where they tore down. I mean, King's Cross, just to give you some context, was a rundown area, an area we had kind of the red light district, a lot of kind of drug activity going there. It was a no-go zone. And now it's become, they've created a new postcode, which I believe you guys call it zip code. And it's very trendy. A 2-bedroom flat in that area currently, you're looking at $4,500 per month. £4,500, which that in your, probably be around about $5,500 for a 2-bedroom property.
Wow.
In this property, in this area, that was unheard of sort of 15 years back. I mean, no way, no freaking way would that cost. But now it's like it's secure, it's safe, it's trending. You've got the Google offices. I believe that's where they have the largest Google office outside of the US, if I'm not mistaken. You've got offices like Facebook very close by as well in the area. You've got Amazon. It's become this tech area, sort of like Silicon Valley equivalent, and it's become very, very expensive. We have one of our offices out there, and it's one of the most expensive offices when it comes to rent. So yeah, it's corporate landlords coming into the market have private smaller landlords shaking in their boots.
Well, it kind of reminds me, and I'm probably I'm probably dating myself a little bit with this reference, but I'm going to go ahead. It reminds me a lot of the movie, the old Kevin Costner movie, Field of Dreams, where they say, if you build it, they will come. You know, so you build, something that is desirable. People at that has what people are looking for today, which are probably modern amenities, things like that. They will come, even if it's areas that you look back 5 or 10 years ago, like you say, is like a no-go zone or what have you. And I may not have understood the question you asked me at first about these corporate landlords. I was thinking mostly just in single family housing, because
Gotcha.
I'm
Different
not
market.
seeing that in
Yep.
single family housing.
Yep.
However, what I will tell you is I think a lot of what you're seeing there is going on in this area as well, where um, we have, of course, we typically call them either apartments or condominiums here. I guess you would call them flats, but
Yeah.
there's really not a lot of condominiums being purchased. Now, these would or being built these days for people to purchase, but there is just a plethora of once again corporations coming in and building up these in DC and in some of the surrounding suburbs that are close into DC.
Hmm.
A ton of rental housing, and it's got all the amenities that everybody wants. I mean, it's not these 1970s, 1960s built stuff that's all old and has asbestos
Exactly.
and lead
Yeah.
paint and all that. I mean, these have the gyms, these have, and the prices that they're getting for them are outrageous. I actually have a daughter of mine who went to medical school, and she's actually doing her residency here in the DC area. Fortunately, she probably won't be here for long, but she's here right now. And when she was coming back into town, I mean, just like I helped her try to find a place to rent, and I was amazed because once again, I'm not really in tune with that so much, that marketplace as much, but yeah, it's amazing the buildings that are there and just the amenities they have. And especially the younger people, the millennials and Gen Zs, I mean, are really, and what, even some of the older people too, but the rents that they're getting for some of these places, and some of them have been great places for quite some time. It's just, either there was just empty area where they were able to build on. Sometimes it's letting leases run out and tearing it down and building back up. But some of these, but some of these areas, to your point, I mean, are in areas that I wouldn't have gone to 10 years ago, and now it's like this is the new happening place. Dog
Yeah.
parks, breweries and restaurants and outdoor everything. So yeah, I hear what you're saying. We're definitely seeing a lot of that. I kind of have concerns, just simply, it seems like there's just a lot of overbuilding, but people keep coming and the rents keep going up. So
Exactly that, and I've been converted, by the way, because I mean I'm old school, and especially I've always loved the period homes, which you get a lot here in the UK and especially in London. And I've always been, it's all about the period homes, the features and everything else. But over the course of so many years and the buildings that I've seen, and the way that they've managed to be able to combine, a lot of times they can combine both as well, which
right,
is freaking amazing. If you
yeah,
look at Battersea, for example, which is where you had kind of this powerhouse and you had all these industrial things, how they've been able to mesh the industrial with, and kind of preserve the character of the area and everything else, and build these things. So now you can almost have you can have the benefit of both. The old and the new. It is amazing how these architects sort of put this all together.
right.
Um, Listen, we're going to wrap up. Before I wrap up, I just wanted to hear from you, sort of investing, because a lot of my viewers have been asking, is it worth continuing to invest in the UK? And the reality is, the answer to that is yes. The UK continues to be a safe place to invest. Capital growth never disappoints. You may have to wait a little bit, especially when you come to London. I don't know if you get the same on your end, but here at least in London, when you invest in the Southeast, but especially in London, the yields that you're going to get here are going to be nothing in comparison to the North. However, in the North, there's greater risk, and it's less likely you're going to get the capital that you get here in London. So there's always going to be a trade-off between yield and capital growth. And capital growth, in my view, is always going to be where you win. And property is always going to be sort of long term. But hey, my question to you is this: a lot of viewers, sort of, considering and contemplating, is it time to kind of diversify and buy elsewhere? And some of them have said, the US. So before we wrap up, I just wanted to ask you, what that looks like, what yields look like, and how can someone invest out there and keeping sort of risk to a very minimum, because investing in a foreign land, even if it is US, can be quite scary for a lot of people. And
Yeah, I mean,
mortgage
so
specifically as well, how an overseas person buyer for mortgage, how does that work? And that way we can wrap this up with the same topic, which is mortgage.
right. So first of all, land is one of those things that they're not building any more of. What's here is here, and so, and as you said earlier, I mean, you actually gave me some information, because I had no idea how many people lived on this earth, but you said somewhere in the 8 to 9 billion range or so. I mean, that's only growing. And once again, there's no more land that's out there. So ultimately, in the end, values are going to continue to rise. It may not mean it's every year. Real estate, just like the stock markets, are cyclical. You go through some up years, you go through some down years, but I think long term, everything it's going to be trending up. We all know that 15, 20 years from now, values are going to be a lot higher for, our kids than they're going to look at what we paid, in the last few years. And while we thought we were paying so much, and we were, they're going to be like, oh my God, mom and dad got the deal of the century there. So I think the capital value is going to continue to climb. I do think that mortgages right now, I can't really speak to, as someone outside of the country. You know, I'm not sure of all the ins and outs there as far as being able to obtain a mortgage. I do know that, in the DC area, we have a lot of foreign investors. Um, but I do think that, ultimately, it's a good investment to purchase real estate. I think values are going to continue to go up. And so that's kind of my take.
Cool. Well, thank you, Kevin. Much appreciated. Anyone who wants to connect with Kevin, just feel free to message me, and I'll be more than happy to put you through. But appreciate it. I know it's still early out there. For me, I'm going and getting some dinner to wrap up the day. But appreciate you coming on board. Really do.
Absolutely, Danny. Thank you so much.
Thank you, Kevin. Take care.
Take
Bye
care.
for now.
Bye bye.